Hey everyone, welcome to the Raising Millionaires podcast. I am your co-host Roger Bryan, and that is
Richard Lorenzen.
it is great to have you all here. Today we are going to be talking about tomorrow's Fed meeting. We're going to be talking tariffs, trade, and apparently the first Chinese cargo ship is import and offloading products with the 145% tariff. What does that mean for you, your investment portfolios, and whether or not your kids are going to starve because you can't afford the price of eggs? We're also going to talk a little bit about Berkshire Hathaway's annual meeting and the huge news from Warren Buffett. And then we're going to dive in and we're going to talk a little bit of real estate as Richard and I are diving into deals and trying to find out where to jump off on that real estate fund. So Richard, let's start with the Fed meeting that started today and the potential for interest rate announcements tomorrow. What's going on there?
Well, Fed's meeting right now. Tomorrow we'll get a decision from them on whether or not they're going to cut rates or keep them the same. You know, for the last few months leading up to the meeting, the consensus had been for a while anyway that a Fed rate cut was going to be likely, if nothing else, because of damage to the economy from tariffs. But now, as we're getting closer, it's looking more and more likely that the Fed is going to keep rates unchanged. And so,
what are the markets going to think about that, though?
Well, at this point, you know, it looks like leaving rates unchanged is almost priced into the market. I would think you would get more volatility if they came out and cut rates. And I don't know whether necessarily that would be good or bad, because at the same, you know, while it does make money cheaper, it also kind of sends a signal to the economy that the Fed might be concerned about the direction of the economy, and especially coming on the heels of the bad GDP number that we saw last week, which we should also talk about. That might send a signal to the market that things might be worse than people believe. And so I think the Fed is going to keep rates unchanged. I don't know if it's necessarily going to move the market much if they come out and say that it's unchanged. I think the market will be looking at some of the comments that you see come out from Powell and guidance from him on where he sees the rest of the year going. But I feel like the rate, you know, the interest rate news that would be more likely to move the market would be a rate cut at this point, because the consensus
even the psychology of the markets today, though, too, right? If it does, and I've got the SPY options up, so I'm thinking about my trade, and if I'm going to do anything, right, the gap is small. It's 1%, right? I look and typically see a 2.3 to 2.9%, and this is on the puts. So I'm going to look at the calls here in a second. If I can price around a 2.3 to 2.9% spread, that means the price of the option relative to the strike price, right? How much does the price have to change in order for me to hit the strike? That is a super small margin relative to what the market's been giving us. I'm going to look real quick. It's 1.1, 1.2% on the call. So no one's pricing in an extreme move tomorrow.
Yep.
What does that mean?
Well, like I said, I think at this point it's baked in that most people expect rates to remain unchanged. And so most likely that's what you're actually going to see come out of the Fed meeting. And I don't think you'll see a lot of movement in the markets either way. That the markets are down a little bit right now. I think we're off almost 1% last time I looked on the S&P. That's, you know, coming off the back of one of the longest winning streaks that the market's ever had over the last couple of weeks. I think we were up for 20 straight sessions or something similar to that. I don't think you're going to see a big move in the market tomorrow, assuming that rates don't get cut. If we do see a reduction in interest rates, I think that's when you would start to see, you know, one way it could play out would be an initial bump because of the excitement of cheaper money. But I feel like it would be followed by, I feel like the rally would be faded, and ultimately we would
Well, you're saying if they cut?
If they cut.
We see a 2,000 point move if they cut.
We could. But like I said, I think that initially I think ultimately that rally would fade, and you would ultimately see the market head lower because of the implications of what the Fed is saying by cutting rates. Especially after Powell's come out the last few weeks, or different members of the Fed have come out over the last few weeks, um, telegraphing that they don't think the economy is in a place where a rate cut is needed.
And I don't disagree in any way, but I'm also looking like if I short SPY thinking that we'll get a greater than 1% move because the Fed won't cut rates, but then that's the May 7th. Oh, that's weird. That's right.
I don't see a significant move to the downside for keeping rates unchanged.
I do. I think it's
Unless,
the emotion of it.
well, like I said, I think it's baked in. But if the guidance that we get from the Fed signals, a more negative sentiment than what we think, that might be where you see the move down. If Powell comes out and says that they think that labor is softening more than they expected, and it might lay a foundation for cutting rates at the next meeting, like, to me, that's negative guidance that would push the market lower.
Okay.
So I don't know if we're going to have very much excitement from tomorrow's Fed meeting.
Yeah, and again, it does feel like I'm trying to force a trade, which I never want to do. So I'm probably just going to stay on the sidelines. Now let's close the book too on last week's conversation where
Amazon.
Yeah, the trade on Amazon. Man, was that one all over the place.
So just recap what you did.
Okay, so I shorted Amazon, and we talked about shorting it. Now, the one thing that I did different is I did it a week out. Normally, I like to do it the day before.
You bought puts on Amazon.
Yep, I bought puts on Amazon, feeling like if the quarter itself wasn't not great, that they were going to have to issue forward guidance that is not great because of tariff impacts, right? China tariff impacts particularly, and that there's still the fading of the AI trade. And basically, in between all of that, too, was a lot of Fed data points that I saw coming in negative. And you know what? Every single thing lined up until Friday, right? Or late Thursday. I said the one variable that could really skew this is trade talks, right? The administration comes out and says that they're in trade negotiations. And they said they've got a deal done, but they've never announced two. We're in talks with China, and today they backtracked on all of that in fact, there are no talks with China. Thank you for doing that on Friday and backtracking it on Tuesday. Now, you would think with all of that maybe the trade went south, but it didn't. The very first day that it came out, right, that next morning, Trump attacks Bezos over their idea of putting tariff pricing up on the screen, and Amazon stock tanked. So I was able to exit half of my trade at a 62% profit, right? I looked at that, and I knew I had to take money off the table, right? It really covers my downside risk. And I mean, in hindsight, I should have taken it all off the table, but my thesis was still there, right? I was 5 minutes into that trade relative to the first day of trading, and I was up 60%. Took the money off the table. It went to about 80%, but then I started to watch. And then the stock started going all over the place. Up 5% or 4%, down 3 to 5%. And I kept trying to catch it, but I'm like, I want to play this out through earnings. I got everything I wanted on earnings, and the stock plummeted even more in after hours. And then in after hours, tick up, tick up, tick up, tick up, tick up, down. It did that twice, and then it ticked up all the way through the morning, and it actually opened up relatively high to where my strike price was. And the first chance it got to drop, I sold another 25%. There was a $10 option. I sold it at $8. So right down 20%, but still up. and then the rest of it I'd sold at 7, so down 30%. I averaged out at like a 12% profit, which isn't bad for a week, but I could have had 60.
Yep.
The learning from this, though, was that my entire premise, or every aspect of what I said was going to happen, happened, but I can't control the variable of news. And you have to trade against the probability that the news goes in the opposite direction of you and hope that the fundamental reason for the trade is still good enough. In a Trump era world where news has such a huge impact on markets, that's a crapshoot. You're better to play into, right, what we think he is going to do, because he does forecast it, right? He tells you, if you buy now, you're going to make a lot of money. All you got to do is listen. So still turned out to be a good trade. Could have been better. And it does, and every one of those shows a weakening economy. It shows weakening forecasts by major companies. Everybody except, Microsoft even lowered their guidance a little bit, but had a blowout quarter. I've actually been watching them this week for a potential short because they've been up so much, right? It's gone past a reasonable uptick, but there's also people looking for a mega cap tech stock that they feel safe in, right? Amazon's not it. Tesla's not it. Nvidia's not it, right? If Microsoft is the last of them to be able to pull that type of cred, then you're going to see an inflow of capital, and it's supporting the price. I do feel like any other movement in the market, though, and the wind's going to come out of that one quickly. So if I'm looking at tomorrow, right, I could trade the VIX, I could trade the SPY, or I could go into probably a Microsoft that has even narrower margins and try to get a deflation of price move. Or I can do nothing, which as of right now is probably what I'm going to do.
Yeah, it's tough to call this one. It's interesting. I see Amazon's back at 185 now, so it's more or less.
It's right where it's supposed to be, right?
Yeah.
All the studies say that's right where it's supposed to be, and that's what I traded on.
Yeah.
I'm wondering though, like, I'm not the biggest fan of those elongated trades.
No, it's like I said, it's just more stress for your buck. Like
it is, and I mean I know better. Like 60%. Take it all. Like, what more can you get out of that trade?
Well, you were going for 100. So.
Well, I do. I always go for 100. That's like, I never not take 100%. Never, never, never. 100% of the time, I'll take 100% profit. But then again, who wouldn't? I might need to cut that down to like 50 and just be in and out a lot faster. Because a lot of times, those moves happen almost instantaneously. And if it's during market hours, you can exit pretty nicely.
Yep. I see the VIX right now is up about 5% on the day, a little over 5%.
See, that tells me people are expecting some volatility tomorrow.
It does, especially with the overall market, S&P being down just under 1% right now. Half a
down, it's still under 1%?
Half a percentage point lower
that's
on the
S&P. That's a normal day, right? In fact, that's less than a normal day in a Trump world.
It is, but also to see the VIX up 5%, the commonly called the fear index of the market, to see that moving 5% on a day where things are relatively quiet, like that could be telegraphing something about how investors are feeling about tomorrow. So maybe you do want to look at that trade on SPY.
Yeah, I've got it up on the screen. I'm going to watch it a little bit through the end of the day. I probably wouldn't go heavy into it. But I might do the 560 strike for Friday is at 555. So it's pricing in a 1% downtick tomorrow. The only thing that could happen that would put that in the other direction is if the Fed miraculously cut rates, even by a quarter, but they're not going to.
Yeah, I don't see that being likelihood at all. I would say there's probably less than a 5% chance.
Okay.
So
would have been a good trade yesterday. That trade's up 50% on the day.
Right. Yeah, the market's been coming in a little bit the past 2 days after having a long winning streak. Not particularly enormous from a percentage standpoint, but in terms of a number of sessions, it's been up for,
I think it was the longest winning streak ever, 20 sessions in a row.
20 sessions in a row.
It's like being at the roulette table in Vegas and it's gone red 20 times and you're like, I'm just going to bet black.
Yep. Which is basically what you're thinking about doing.
No, there's a little bit more sound and strategy behind all of this.
But like the market is back at its pre-Liberation Day level as of this week. And so wish I bought a little bit more at the bottom.
Yeah, we all do. And there was Paul Tudor Jones was on today and saying that we are going to see new lows in this cycle.
Yep. So that was something that gave me some faith.
Yeah, faith in the downside.
I would like to buy a little bit more, and I wish I had bought more at the low. But yeah, so Paul Tudor Jones was on CNBC this morning, predicting that we are going to see new lows, even if Trump dials back China tariffs to 50%, which seems to be what Paul Tudor Jones.
Let me ask you a question though. If you listen to that interview, and you're trying to think through what he's about to do, and he was the hype man of fear of AI, right? He is in the belief that with, I believe it was from Elon Musk, that in the next 20 years, there's a 20% chance that AI wipes out half of the world's population. And that he just came from a conference that there was a 50% chance that AI makes a mistake in maybe biohacking of some type and kills 50 to 100 million people in the next 20 years. What did he invest in that is the counter to that to make sure that it doesn't happen? Because none of them come out with fear unless they've got an investment or a product coming right behind it. Mm-hmm. Where is that? Who's got the solution to that problem? Because wouldn't it have to be government agencies to step in to regulate AI? And if the U.S. stepped in to regulate AI, wouldn't Russia and China just laugh at us?
No, I agree with that. I don't know what it is, but
I don't know what it is either.
But I don't think you're going to see like meaningful regulation coming from Congress on AI anytime soon.
Well, then I think that was the point of it, though. Like, it's not going to happen until something bad happens. Something catastrophic, and then people are going to be like, oh, we let AI take over, and now we're all dead. Whether you're thinking Terminator style, or if you're thinking that, like, it creates some medication. What was that movie, then, with Will Smith?
If it happens, I'm coming to your bunker. So
you can't say that on live stuff. No, what was that movie with Will Smith where they have, like, this pill that's supposed to make you live forever, and then everybody turns into zombies and dies?
Oh, I don't know.
Oh, never mind. Not important.
I'm not cool enough to know all the
I could see AI doing that, though.
Okay.
Only people that have bunkers watch movies like that. Then, did you hear the Steve Ackman interview yesterday?
No.
Okay. For those of you that don't know, I think brilliant investor, but he is like the Gordon Gekko of this generation, meaning that he's so sleazy with what he says.
What do you really think about him?
Yeah, well, I don't exist to him, so who cares? His big thing is that, like, they made some investments, and people are saying that he's going to be the next Warren Buffett and his company is going to be the next Berkshire Hathaway. By the way, I am doing air quotes for the YouTube video. You might not be seeing those on this. But then he followed up that interview with a post talking about how the new CEO of Berkshire Hathaway is going to start issuing dividends, which would be the most anti-Warren Buffett move of all time. And you could tell that Steve Ackman's positioning, I am going to have the next Berkshire Hathaway, but we're going to issue dividends at the same time. Don't you think those two things kind of contradict each other?
Yeah, that's dividends are like, like you said, it's the complete opposite of like the Warren Buffett doctrine on investing. Whether that happens under a new regime at Berkshire Hathaway, who knows? I feel like Greg Abel is pretty in lockstep with Warren Buffett.
I don't think that this next generation of leadership, that there's even a 1% chance of that happening, right? The next generation, Abbott, Nell, and the board, like, they're going to carry on the philosophies of Warren Buffett for the next couple decades. Yep. I can't forecast what happens after that, but the core premise of that company is the compounding rate of return by not issuing dividends. It's like Warren Buffett's credo on the power of compound interest. And we talk about that in just about every podcast when we talk about investing for our kids. It screams slime ball I don't know. I don't know. I don't expect anything different. But you hear that, and I can't be the only person on this planet that goes, "Oh, come on, you're full of shit."
No, I don't see it happening. I think the only challenge that Berkshire has moving forward is they've gotten so big. They have such a big pile of cash that, how do you get enough opportunities to put that cash to work?
You let it compound until shit hits the fan, just like it did in 2008, just like it did in the
Right.
pandemic, and then they go in and they when
Since
when you have a 94-year time span,
That's
right?
right.
You understand that I don't have to buy in the next decade, but when I do buy, the rate of return is going to be so great that it's going to pay for the next 4 generations of people that are invested in this.
No, that's right. That's
And
right.
I guess we both have to say that we both do own Berkshire Hathaway, so
Yeah, we do.
I don't have to say that very often, but that one we do have to say. Okay.
Yep.
And we've got to go next year. It might be a 50-50 shot of whether or not Warren Buffett is there.
He may still be on the stage next year as chairman.
Yep.
I wouldn't rule it out. So we're gonna go. We'll commit right now.
Yeah, we're committing right now. In fact, let's find the Airbnb. Let's reserve the damn thing.
Yeah.
And just not look back. Was it 2 months ago? We're like, we should go this year. And then you wake up and you're like, shit, the meeting's this weekend and we're not there.
Yeah.
Okay, sorry. Oh, no, I wanted to read that.
So markets.
They're popping up a little bit, right?
Yeah.
560, 555.
Copy.
560, 560. It's like locks.
We had the GDP number come out. I get now it was last week at this point. So last week the GDP number came out, which kind of rained on the parade of the market's consecutive winning streak. What'd you make of that number?
Well, I told you what it was going to be, like in our last call. Like, I'm making this Amazon trade because the data that's coming out on Wednesday, Wednesday, Thursday, and Friday is all going to be negative forward looking. Now, the only one that wasn't then was the jobs data last Friday, but Steve Leisman pointed out something super important. The bump up was all in warehousing and transportation, right? It exactly matched what beat expectation. He's like, well, anyone can tell that's just because more goods are coming into the country right now as people get ahead of tariffs, right? Without that, the numbers would have been exactly where I said they were going to be. So my crystal ball is finely tuned for that stuff.
No, it's true. Well, the tariffs are skewing a lot of things. You could say, also with the GDP number that, so the GDP number came out, it was negative. A lot of that, it seems, was due to a spike in imports, from companies that were trying to stockpile inventory ahead of tariffs going into effect. And so that also skewed the GDP number a little bit. Something to also keep in mind that
I think all of the data skewed. Who was as I was driving back from lunch? Oh man, he's on often enough. I should know his name. But he was talking about how, or Steve Leisman corrected him about how the data is not forward-looking because it can't predict the future of what we don't know that's happening, but it is actually forward-looking in reflection of what happened, right? It can tell you where it's going to go, but it can't tell you where it's going to be, sort of conversation, which is kind of a weird one to happen. But all the data states things are getting a little bit worse. And even if tariffs come in at 10% across the board, the choking of the economy is already starting. And that unless they completely wiped out tariffs and we go back to full consumption, right, there's going to have to be a downtick somewhere along the way in all of this.
Yep, no doubt.
Okay.
VIX is still up.
What were some of the other big takeaways from the Berkshire Hathaway meeting? Because they actually reported slightly disappointing results.
Yeah, they did. Earnings were lower. I didn't read too much into what the contributing factors were. Obviously, overall, pressure on growth played a role. But again, like, to me, I feel like the biggest challenge for Berkshire is just how can, with a cash stockpile so big, even if you're finding some great opportunities, how are you going to put enough cash to work that it drives an overall like meaningful return on total equity? You know?
Okay, so this is going to be a sidebar, but it connects. Treasury auctions yesterday and today.
Yeah, yep.
The federal government is easing, they're tightening. Kind of a conundrum in saying that. But they were 20% buyers of the bonds that were in market, which was an uptick. How do you get return on the money? Warren Buffett said last time we were at the annual meeting, right? Treasuries, right? If he can get a 4 to 5% yield, which that's it's not 4 to 5% at this very moment. It's in the closer to the 4%, right? He doesn't need to go spend the money. 4% on that large of an amount, right? 4% on $300 billion is still a huge monthly number.
Oh, it is, for sure. Right, the 10 years at 4.3% right now.
And I think when we win, it was closer to 5.
Yeah. Let's see. Yeah. Yeah, I mean, I get it. If you can get a risk-free return of 4+% on T-bills, especially in a year where it looks like a lot of the consensus for equities on the S&P anyway is going to be something like a sub 5% year. Why take on the risk of being in equities?
Oh yeah, it's zero. I mean, relatively speaking, it's 0% risk without a major economic collapse. Not even an economic collapse would probably drive rates up in some regards.
More people would buy T-bills.
Yeah, more people would buy T-bills. I guess the way that I should say that is there are people that believe Trump could come out one day and say, you know what, the U.S. government owes nobody any more money, all the debt's wiped out. Wouldn't go over very well, but that's like the biggest risk, and the probability of that happening, fractional of 1%.
Right. So yeah, it goes back to if you're an investor, and especially if you're a medium to shorter term investor, like let's say you're getting older, you're thinking about retirement, and I want my money in the next 2 to 5 years, why am I putting more money to work in equities instead of just buying a T-bill at 4%? So
I'm trying to think of something here. Okay. Okay, let's go back to real estate for a second. So I sent you a couple,
real estate, yeah.
Yes. Sorry, I'm getting distracted. I always want to make a trade a week. I really do want to.
Okay.
And I don't like to force it, of course. But the more we talk about it, the more things are lining up. Right, It's below a 1% spread right now. I want to double check and make sure I am looking at Friday on the expiration. I am. This is just rare, super rare, and I'm trying to figure out why. While we ponder the why of that, what am I missing? Real estate. I sent you a couple deals, right? I think I sent you 3 properties, or at least 2, but one of them was actually a 1 of 2. Like there was another one available of the exact same thing.
Yep.
When we always talk about the types of deals that we were looking for, I felt like those were perfectly aligned.
Yep. Yeah, like I'm looking at one of them right now. It was a building that has, how many units does it have? So it has, I think it's 8 units. It says 8-bed, 4-bath. Am I correct?
No, it's 4 units. Each one has 2 beds.
Okay, so 4 2-bedroom units.
I would never buy a 1-bedroom in this area. Like that would only work in like a city.
Okay. So 4 units. Let me see, what is the price per unit on this? So it's a $420,000 property divided by 4 units. So you're looking at $105K per door. And then I think you had told me that the cap rate on this deal was somewhere in the 9 to 12% range.
It was, depending on how you calculate monthly expenses, like what ratio you use.
So if you wanted to take down a deal like that, 420K, and let's assume we're going to pay all cash because that's what we've been discussing. Um, 9 people that chip in a 50K check will basically get that deal done.
It would, and here's the interesting thing. So not that deal, but the other one, the duplexes. So after I sent you those and I cap rated them, I think at like $1,000 a month rent for each side. I
Okay.
started doing research on the rental rates of those properties, and I started finding similar properties, similar neighborhoods. You know what the monthly rent was?
For a 2 bedroom, what was it?
1,400.
1,400 for a two
Yeah,
bedroom.
not in the 4 unit, in the duplexes, right? I calculated out everything at $1,000 a month rent, and I looked at the market. I couldn't find anything below 1,400.
Okay.
I was blown away.
So this 2 unit that you sent me, it's a 2 unit, 2 bedrooms in each unit. 189 is the asking price. And you were saying, what did you just say? 1,700, 1,400 for
1,400 per side.
per side. So that's a total of just under $3,000, like $2,800 per month gross rent roll. What are you currently seeing margins run at for expenses on a 2 unit like this?
You're supposed to calculate 35%.
Okay.
When I look at what
A 35% margin or 35% expense rate?
expense rate,
Okay.
35% expense rate, you're supposed to calculate that. But I look at the portfolio that's being managed by close people that I'm close to, and theirs is in the very low 20s.
Okay.
Now, they do have an economy of scale advantage where they've got 50 plus properties. So they have their own in-house people to do a lot of things that might not work for someone that, say, has 5 doors and has to like hire someone part-time, right? You think that part-time actually means less expensive, but over the wide breadth of service, it's probably going to cost you double. You need that economy of scale where you have enough money coming in that you can just have somebody on staff and you're paying them a reasonable hourly wage instead of an outsourced wage.
So I'm just doing some quick math. 1,400 per month per unit for those 2 units at a 35% expense rate. That would put your cap rate on this at 11.6%.
Which is golden.
And you think that the expense rate is conservative? Like
Yep.
it could even be
Always overestimate expenses and underestimate income.
so like 11.6%, and we're paying all cash for the property. So that's pure cash flow. Those numbers are good.
I know. And I always come back to, are they so good that, like, why don't we just buy a handful of them and be done with the whole thing? But I do want that economies of scale. Plus, I want that 20-year exit on the whole package.
Yep. No, yeah, you've got to build scale. Even at 2,800, like 35% for expenses, 980, so 2,800, 980. Even if we were buying these ourselves without raising money, right? Like our net monthly profit is $1,800. So like you need scale to really build a company around that.
Yep.
You would need you need like 100 of these.
Well, and now it's relative too. Like, you live in New York, you need 100 of them. Someone living in Ohio needs 10.
True.
Yep.
True. As a personal investor, I'm thinking more along the lines of like if we're building an investment firm.
Oh, yeah. Sorry.
If you're building an apparatus around building a company, you need a little more revenue there.
Hold on. I got to change a number on something real quick. It's bothering me.
So, but that deal is excellent. So if we could find more of those, if there's enough of that inventory in the market that we can scale that, I'd take 11% all day long.
Yeah, and the thing is, those deals don't stay on the market for very long. But I would say in any given month, right, I looked after we had our last conversation and found 3 of them, right? That's 8 doors. And I bet you They'll probably be gone. They'll definitely be gone before the end of May. They'll probably be gone before May 15th. But then a month from now, I'll go look and there'll be a whole different set. Sometimes it's 2 buildings, 2 duplexes like this one where it's 2 different listings, but there's 2 of them. Sometimes there'll be 4 of those. The communities were built where on the main streets, it's all duplexes.
Okay.
As you connect the major shopping areas. And then as you get out of that area into the neighborhoods and you get into single family. The nice thing about that is high traffic, right? They're a breeze to rent out because you've got 5,000 cars a day driving by them, if not more.
Yeah.
But Richard, I'm not joking. If I look out my window and I go left, it's about 5.6 miles to the freeway in the main shopping center. And I probably easily drive by 100 of these units. And that's one street, one main street. Between, I guess you go from Canal Fulton through Jackson, and then you start to hit Canton, Ohio on the other side of the freeway. And if you keep going past the freeway, another 5 miles to the high school, you probably hit another 100 of them. So that's just how this marketplace was, this community was built.
And we could put together a cold calling and cold mailing operation to, why limit ourselves to the ones that are on the market? We can reach out to every seller. Every owner. We can reach out to every owner.
Most of them, like if I read the Canton Repository and I look at the sales transactions, every week when that comes out, there is out-of-state investment company buys 12 properties. Out-of-state investment company buys 20 properties. None of those properties were ever on the market.
Yep.
That's exactly what they're doing. Yep. There is enough supply to build a $15 million portfolio in a year without blinking, barring any major economic changes.
Right. Okay, so the inventory is there. The numbers on this deal work. It's been on the market for only 12 days, this duplex that you sent me.
Yeah, and I wouldn't doubt, unless there's major repair issues, if it's not already in negotiation to sell, right? And this happens with any property. You go into it and right, the roof is leaking, the foundation is cracked or something like that, the yard's a mess, all stuff that can be fixed, but needs to be addressed.
Yeah. Well, maybe we should send you on the road to do a tour of one of these and report back.
I could, but then I might end up buying
it. So the next step from there is going to be identifying investors, potential LPs, getting commitment letters so that we can move on one of these quickly. Because like you said, this one's been on 12 days. It's probably already in talks or maybe even has an offer. We have to be able to move quickly on some of these. This is not a huge deal at $189,000. Like if you wanted to put it under contract just to lock it up, like the earnest money on that is not significant. And so
you could probably get away with $2,000 to $5,000.
Oh yeah. So if we did find something amazing and we had to move right now, we could also lock it up, put it under contract, and then hustle to raise money on the back end. And it's not super difficult to put together a $200,000 deal.
It is not. All right, we're already at 40 minutes. I think next call, we got to talk a little bit about, right, from a marketing perspective of the fund, we've talked about before how the ideal investor in this fund is somebody that wants real estate exposure for diversification of the portfolio, but doesn't want to manage real estate, which is 95% of the self-employed millionaires that are out there today. It's a large market. How do you make them feel comfortable that the management team of the fund can also manage the property, right? Maintenance, collecting rents, proper insurance, proper legal structures, all of those types of things that like help them sleep at night putting their money into that fund.
Mm-hmm.
Okay, think about that.
Talk about it.
And let's talk about it on next week's call. I would like to thank our real sponsor, V8 Energy, again, for helping me get through this call. By the way, V8 Energy, whenever you're ready, I'll give you the name to where to send it, name and address of where to send a check. But if you're ever needing for a pick-me-up before a podcast, V8 Energy, 100% all natural fruits and veggies in a can. Ooh, so delicious. That was bad. All right, Richard, please stop this.
All right.